All right, well, welcome everyone to today's webinar. My name is Roger Swift. I'm an advisor with the North Central Texas Small Business Development Center. Today, believe it or not, is National Lemon Meringue Pie Day, right? Gosh, everybody loves lemon meringue. I know I do, but even more importantly, today is the start of the 24-25 NFL season. So if you have not set your lineup, man, right after this webinar, you got to go do that. All right. So reminder for that. All right. So the SBDC is a leading provider of assistance for small businesses. We are grant funded, which allows us to offer the services at no cost. Today's webinar is your mission as a business and how it reflects in your tax return. A quick reminder, we are recording this session and it will be added to our YouTube channel. Today's webinar will be interactive, so raise your hand with the button down at the bottom there in the webinar and/or unmute yourself, and you may ask any questions or make any comments. Our presenter today is Bryce Forney. Bryce is a Bay Area sole prop CPA preparing tax returns mostly for business owners who use cloud books for their business. He is understandable, likable, mobile accountant working in the hotel lobbies, libraries, and liquid spaces. He is a great resource, and this will be an excellent webinar for you to watch. Bryce, I'll give it off to you.
Okay. The first thing I'm going to do is the trickiest part, which is to share my screen. Hopefully that shows everything. We all green light as far as the title slide?
Yep, we can see
Okay.
it. Great.
So if you've been to the other sessions that I've presented and that Stacy Kildall has presented over the last few weeks, we got really technical, which is a lot of accounting and tax, no surprise there. Today, we're going to get more qualitative and I wouldn't say spiritual, but definitely deeper into the intention behind your business, something that we don't talk about all the time. So we're going to kind of dissect what your mission in business is and what's specific to you, what's common to all businesses. And we're going to look at some tax returns and compare what the tax return shows or what the profit and loss statement shows about a business's mission. So it may sound kind of confusing at first, but hopefully it will be clear by the end. So the SBDC is an available resource for you. So just to reiterate, the SBDC is out there for your success. So these training and resources are available to you at no cost. So take advantage of your resources. That's always the case in business. So I want to do just a brief introduction. It's not so important that you know who I am, but what is important is that you know the perspective from which I'm coming in terms of how I'm going to discuss today's topic. So I'm a CPA preparing tax returns. That's almost all of the revenue I generate is preparing tax returns. And almost all of those tax returns contain a business component, whether it's a Schedule C as part of an individual tax return or an S Corp, C Corp, partnership, LLC, and even some tax-exempt entities. Some people like to refer to tax-exempt entities as nonprofits, and I detest that term. And today's session really defines why I hope you'll agree with me that even in the case of a tax-exempt entity, they need to make sure that revenue is in excess of expenses. They can further their mission to society by making income. So I'm really active in client books. So that's something that distinguishes me from other tax preparers. So I really like to be in the books and looking at transactions, whereas some tax preparers really want nothing to do with the client's books. So with that, let's start with the definition about what is your business mission. Your business mission is partly what defines you specifically in terms of what you're selling to customers, maybe how you're selling your product or service to your customers, and who your customers are. So those elements of your mission are going to be specific to you. Well, they could be specific to you. For example, I'm a tax preparer. So what I do, a lot of people are doing really a very similar activity. And the work product is the same. The marketing is actually very similar among tax preparers. We have little differences in terms of how we practice and what our target customer is, but the market is highly competitive. There are a lot of players in the market. So that makes it so basically we're doing the same thing. Whereas if your product is unique, I'm thinking about a client I had some years ago, and this is before the product really existed on the market. They were creating coconut chips as a snack product. They were based either in Berkeley or Emeryville. I can't remember now. But they were the first ones, or really the first ones certainly I was aware of, that came out with coconut chips as a snack product that competed with potato chips and tortilla chips. So that was a really unique product. And obviously, in their mission, they would have a lot of information about who they were trying to get to purchase this product. So a lot of what their mission was about identifying their customer and identifying the market in which they wanted to sell. Now I think it's basically nationwide, but at the time they were capitalizing on more or less the Whole Foods customer to be the test case for that product. So your business is going to reflect those specific elements of the products that you're selling or the service that you're providing. So while that part of your mission is absolutely unique to you, there is another part of your mission, or should be, that really every business shares. And that is the financial goal of a business. The financial goal of a business is always, always, always to make money. And we don't talk about this a lot, which is why I think this is important to bring up. But your mission and your daily activities as a business need to be focused on bringing in customer revenue, uh, having the appropriate amount of expenses, of course, and bringing money to the bottom line. So the part of your mission, of any business's mission, that is going to be shared no matter what the business is, whether it's a large public company or a solopreneur like myself, the part of earning income needs to be embedded in that mission. And the reason that that's important, of course, it's important to be able to provide for um, wherever this income is going, but tax wise, it is necessary, it is critical that if you are operating as a business and you're going to be telling the IRS that you are a business, your purpose is to generate income. So I've put here the IRS definition of a business, which the quotes from the IRS are not always the most sensational, but I think this is great because it's saying you're performing this activity primarily for the production of income. You're selling goods or performing services for the production of income. That's the most important thing. And some businesses can be distracted either because there might be a social component to what their business is, and that can, I won't say overtake, but that can really cloud what is the function of a business. And the thing that comes to mind is I watched Shark Tank like a lot of people do, and I remember actually one of the sharks, his business was, I think it's Tom's Shoes. I think that's the name of the business. And part of Tom's Shoes, whatever the shoe business was, is that for each pair of shoes that they sold, they donated another pair of shoes to individuals in foreign countries who, had a shoe shortage. So that was a big part of what their marketing pitch was to their customer, that if you buy a pair of shoes, we're going to give a pair of shoes to people who need who need shoes. So that's a great part, of social responsibility as a business. But what's even more important is that net of giving away a pair of shoes and selling the shoes to the customer, they need to generate an overall profit. So social responsibility can absolutely be part of what your business is doing, as long as it is secondary, it is subordinate to earning income, producing income, because that's how the tax return is going to report what your activity, what your endeavor is all about. So let's first talk about the unique elements of your mission that are not necessarily related to the mechanics of selling to the customer for $10, paying $3 for the product, and having the rest cover expenses. So you have a lot of elements of your mission that are unrelated to the finances of your company. So these include your target customer, who you're trying to sell to, why you created a business in the first place, what it is that you do for customers, and the problem that you're trying to solve in the market. Those are things that are built into your mission, whether you write it down or whether you just have it in the back of your mind. I think it's a good idea to document your mission. It's a good reminder. And I'm not even big on having affirmations on the bathroom mirror and that sort of thing, but I think documenting your mission is important because it helps you to think through, who is my most ideal customer and why is that the case? How can I best reach that customer? And how willing are they to pay for the service or product that I'm selling? Because it's in the mechanics of that or the problem that you're trying to solve. I'm thinking, I just saw something about the like an interview with the Netflix founder, and there were, in that business early on when it was like a DVD thing. I know probably you don't even remember back that far, but it was like a DVD movie rental competing with Blockbuster way back in the day. And they were really had to be focused on solving the customer problem because they were a new entrant in the market and people were not accustomed to getting their movies by mail or planning ahead for getting a movie to watch on over the weekend, most typically. So a lot of people would end up in Blockbuster Friday and Saturday night, scraping through what's left, and Netflix was going to change that. So they really had to focus on what's the problem that our customer has in purchasing our product versus the competition. Obviously, speed of delivery was a big deal, so they did a lot of testing. It's a relatively local business to me. They operated out of Scotts Valley, which is just outside of Santa Cruz, and then their main operation was in San Jose. So they had to deal with the timing of mail, and solving that customer problem was, I mean, it wasn't really a customer problem. It was a need for them to solve the problem, to be able to satisfy the customer and move the customer away from the alternatives of movie rental. So that company had to be really more focused, even I will admit, on getting their product to be liked and subscribed to by their customers and worry about the finances kind of at a later point. Ultimately, it's still really important that they made money, but they had to start by saying, okay, we think there's a market here. We think this is ultimately going to generate income. And for the time being, we have to break into disrupting the market from the very large players that they were against. So in your business, you're going to have what you're selling, who you sell it to, and why that customer is going to buy from you. So I looked at public companies to get some sense of what I thought would be good examples of mission statements that would be relatable. And I was shocked at how aspirational and fluffy the public company mission statements really were. To me, they actually didn't do a very good job of stating their mission. I remember looking at Starbucks mission, and it didn't even mention coffee. It didn't mention selling coffee. It didn't mention what customer they were trying to attract. They were talking about, I don't know, changing the world by working together with community, one cup at a time, something like that. So I just want to move away from those sorts of missions because, I mean, I guess I know why large companies do that. They want to have a great hook for shareholders, but I think they lost the essence of a mission. So I've just come up with an example of a mission for a local pizza restaurant. And notice the components that are unique to this pizza restaurant. So they're creating incredible pizzas from the finest ingredients. So they're specifying that these pizzas are clearly going to stand out. They're not trying to create a commodity style pizza to compete with the large chains. They're creating something that's quite unique. And they're going to sell these pizzas and deliver the pizzas to residents of Sausalito, which is a relatively well-off area in Marin County here in the Bay Area, just north of San Francisco. If you go across the Golden Gate Bridge, you end up in Marin, and pretty soon you're in Sausalito. So it's a very fancy area, even among areas in the Bay Area. So this type of pizza restaurant would actually be viable for that locale. And they're attempting to create a product that stands above other pizzas. And even in the mission, it's specifying that their customers willing to pay 15% more than other local options. So even other artisan pizza makers, they're going to be above that price point. And I think that's great because even though this is talking about the customer and the product that they're selling, they're also embedding in there that they've already identified that the price of their product, either because they built it up based on the ingredients plus their gross margin, or they know the market overall and they know that their price point is going to be that much higher than the competitors. But they've specified it here so that they can be really clear about who is their customer. So those elements of your mission are specific to you. There's not a lot in here about the overall financial picture. It's more focused on the customer and how they're going to make their pizzas. So I think that's a great, those are certainly important characteristics of your mission. The other part of your mission, as I've alluded to before, and what I think is really the number one rule of business, is to make money. We don't talk about making money a whole tremendous amount. It's highly unusual for a business owner to say, oh yeah, I'm in business primarily to make money so that I can provide for my family. And I also like to serve customers and and serve a need. Most of what business is promoting is focused on solving the customer solving the customer need, serving the customer with a given product that helps that customer. And there's not a lot of discussion about the importance of making money. And so that's why I want to emphasize it's that there can be nothing more important than making money, and there shouldn't be any um, uh, heebie-jeebies about making that the number one part of why you're in business. If you're not generating income over the long term anyway, then you're really not a business. So the whole point is to make more money. And I think when it comes to taxes, that can become a confusing double-edged sword, is how some business owners look at it. They want to generate income, but they don't want to pay tax. And the tax system in the United States is built on taxing income. So we have kind of an odd psychology that goes on among business owners where they understand that they want to make money. They're out there generating revenue from customers, and they're minimizing their expenses and trying to make the most out of the customer revenue that they receive. And then when it comes tax time, they also want to minimize the tax that they pay. And I think that's a misconception, partly built up on how some tax preparers talk about that being a goal to minimize tax. And I think that should not be the case. You should focus on earning income, understand that taxes are going to be a result, and the end goal should be to maximize after-tax cash flow, period. It's that simple. And yet, sometimes there can be some fogginess. So that's what this is all about clarifying. So I'm saying that this is the number one rule to make money as a business. And you may be thinking, well, really, the number one rule in my business is to, if you're a hairdresser, you might say it would be to attract the customers that are going to come into my store. And that's the most important thing because I can't make money unless I have customers. So there are other elements of your mission, which we discussed before, the contextual identification of customers, your marketing, your advertising, if that applies, and how you're serving your customers, which is another form, or can be another form of marketing. But those elements of your mission really need to sit below the making money. So having an idea of what your total revenue is going to look like, what your direct cost of goods or your direct cost of performing those services are, is important so that you know this is my target for how much I want to bring in. This is what I've identified as what's going to be a cost so that I can generate net income. So there are other components to a mission. I'm not saying that making money is the only element of your mission, but any rule that you have in your business should really coordinate and tie in consistent with making money. So unlike a government agency or a political campaign, a business mission really needs to specify this is the income that we hope to generate. And then it can also specify how you're going to go about creating that income picture for your business. So now let's switch gears a little bit to talk about the tax return. I've alluded to some elements of taxes in terms of the kind of, it's kind of the way it is depicted most of the time is that it's kind of a set of scales. You're trying to generate income, but you're also trying to minimize tax. And I think that's a misconception. You really want to have as much income as possible reported on your tax return. And some people might react because of the propaganda that's going on. Why would I want to generate more income? That's going to make my tax, more significant. It's going to make the tax element really high. That is not the case. We have progressive tax rates in the United States. You're going to pay really about the same amount of tax per dollar of income, no matter how much you make. There are higher tax rates at higher levels of income, but it isn't some sort of avalanche. And the lower income dollars are always going to be taxed at the lower rates. So that's another misconception about how the tax applies. It's not like you get to a certain point of income, if you're making $250,000, that all of your income is going to be taxed at 40%. That is not the way it works. Your first earnings are taxed at the lower rates, and those higher dollars are taxed at the higher rates. I want to be sure this is correct. In no case are you worse off for earning an additional dollar of income. In fact, I live in California, which is a high tax state in terms of income tax. I think maybe tax is really pretty similar among states. For example, Texas does not have income tax, but my intuition is property tax and other forms of tax are going to kind of equalize the picture. Even though California has income tax, California also has a rule on property tax that it can only go up, the base can only go up by 2% a year. That's known as Proposition 13 that was enacted here in 1978. So our property tax, the longer you live in a property, the less you pay. It's basically 1% of what when you first buy the house, and then that can only increase 2% a year. So the longer you're in a home in California, the less property tax you pay. The point of this is, in terms of income tax, it is a high rate in California. But if I take the federal tax plus the California income tax, we're still talking about, like, at the extreme level, maybe we're approaching 50%. Most taxpayers are really in the 30% combined federal and state income tax level. So for each dollar that most people earn, even in California, they're left with, 6 out of the $10 that they earned. So that's a pretty fair deal even today. So when you think about your tax return, and now hopefully you'll know, the idea is to maximize that bottom line. Of course, you want to claim expenses that are appropriate. There's nothing wrong with that. But for example, retirement contributions are based on the amount of income that the business generates. So the more income that a business generates, the bigger opportunity there is for deferred retirement contributions through a SEP IRA, self-employed person's IRA, or a 401k or solo 401k. All of those are based on net income. So those are reasons to maximize net income. I know it is not very common that you're hearing, yeah, you want to increase the bottom line. You want to pay more tax. You don't really want to pay more tax, but you're paying about the same amount of tax no matter what income you earn, more or less. Certainly within a range. It's not going to change your tax picture that much to earn another $10,000 or another $50,000 in your business. It's going to be really about the same overall rate. So separate from thinking about the mission of the business as to generate income and looking at that bottom line on a tax return, is there income? Thumbs up if there is, thumbs down if there isn't. There is more context behind how a business's mission shows up in the tax return. And so we're going to go through some examples where I hope that you will start to see the components of a tax return that reflect what that business is doing and whether they're consistent with their mission. Because if the mission is to generate income and to have certain percentages behind the expenses, then you want the tax return to reflect that. You don't want your mission to be to make $200,000 in the year after all of your expenses, only to find the tax return shows that you only earned $50,000. You're harming yourself with after-tax lower cash. You're possibly evading taxes, which is not good. And you're minimizing your retirement contributions. So your options are fewer always when you have lower income. It's going to be harder to lend money. It's going to be easy to lend money. It's going to be hard to borrow money. So thinking about tax returns, since Schedule C, the unincorporated business, is the most prevalent tax form that is used for business, with about 23 million businesses in the United States reporting on Schedule C, we're going to use Schedule C as the example. And if you're not familiar with Schedule C, that's okay, because these are the same terms that you would see on your profit and loss statement. So in this case, this is a hypothetical business called Island Ice Cream, and they have total revenue of $2 million. They have direct cost of the ice cream and related components of $1.4 million, making their gross margin or gross profit $600,000. And it's important to call out, that's 30%. So you can compare by industry. For example, if you take the grocery store industry, they have much lower margins, even compared to other retail. Like a hardware store, they would be going for 25, 30%, if not higher, if you're talking about a local hardware store. And then what we have below the gross margin are the expenses that do not change with income. So if this ice cream store sells $2.5 million worth of ice cream instead of $2 million, their cost of goods sold is also going to go up. But their rent and their payroll, at least some of it, and their utilities, those items are going to remain the same, more or less. There's some bleed over, but I think rent is the best example here. For an ice cream store, they've got the same amount of square footage. As long as their landlord doesn't know that their revenue is going up dramatically, they're going to pay the same amount of rent. So we refer to those as overhead expenses, just regular expenses that don't change as sales go up. So in this case, we've got total expenses of $375,000, making the net income of this business just under $250,000 for ownership. And so if we think about what this shows as far as the mission of this ice cream store, we can see that the gross margin is appropriate at 30%. It would be really surprising if gross margin were 80% for this business type. Gross margin can be really high in, for example, the jewelry business. There you can have much higher gross margin. It's difficult to bring in sales volume, so that's appropriate. We can see here that this ice cream store rents for about $5,000 a month, and we can compare the amount of rent that's paid to what the gross margin is, what the business is bringing in after the expense of, in this case, after the expense of the ice cream. So it's important to compare expenses to the gross margin or to total sales, whichever is more reliable, or in some cases just has industry benchmarks out there. So you can search for your business what the typical margin is to get a sense for whether you're high or low. And there, even within that, an ice cream store uh, can try to get higher margin by having some sort of gimmick that's going to make them able to sell ice cream at a higher price. I'm thinking of Cold Stone. I don't know if that's national, but around here, their gimmick is essentially that you can mix things in with your ice cream, and so they move the ice cream around on a marble slab, and then they can charge a lot more for ice cream than a Baskin Robbins, which is just scooping it out of a bin. So clever gimmick. They have their ice cream is much more expensive, and that's a perfectly great tool to be able to get their margin to increase over what the average would be. We can see total payroll is $180,000. We know from an interview with the owner that they're paying their people about $20 an hour. So if you divide the 180,000 by the number of people, in this case is 4, and then you divide that by 2,080, the number of hours in a year, paying someone 40 hours a week, that makes sense. So we would be surprised if payroll was $400,000, and we know the same picture for the number of people. That's really inconsistent with the mission, because now all of a sudden we've got a lot of people involved and our profitability would be taking an enormous hit. So we've got advertising here that we're going to compare to sales. So advertising, we're paying 5% of sales. That's a reasonable rate for advertising. Again, for this industry, I'm trying to think of one. There are some industries that pay a tremendous amount in terms of advertising. I think soda is one where they pay a lot of advertising per dollar of sales. They have to be out there on billboards and doing television commercials, that sort of thing. They have to have their product pictured in front of people, or their sales are going to drop dramatically. So we also see here that our net income, the bottom line there, that 225,000, that's about 11% of total sales, and it's 40% of gross margin. Those are great rates to drop to the bottom line. If net income was, let's say, 3% of total revenue, it's still income, which is great, but you think, why would someone go out and incur all of these costs and hire these people and advertise to customers and generate this revenue, all to make a very small amount of money? That wouldn't make sense. It wouldn't be consistent with the mission. So it's important to compare net income in relation to sales or gross margin. So we see here in this example, we've got a respectable amount of income, and there's really nothing that stands out in terms of expenses and gross margin. So that's the benchmark for our perfect business. As should be no surprise, we'll look at another couple of examples that I, as a tax preparer, would start to it would start to generate questions for me about what's going on. There can be honest mistakes that go on with accounting, certainly, and it's important to have a bookkeeper involved so that those mistakes are less likely. But I want to show you this as a benefit to your business so that you can look at your own profit and loss statement and get a sense for what that's saying about you and to make sure that's consistent with your mission. So here we have Casey's Construction bringing in $5 million in total revenue and paying $4 million out, half to the direct labor of construction and half to the products that the business is selling. So the margin in this business is about 20%. So, and then we have expenses totaling $800,000. So the net income is $200,000. That's still a respectable income, but that's very low income in relation to all of the effort and the total amount of money that this business is bringing in. So because the expenses are so high, the break even for this business is at $4 million of revenue. That is really a risky picture. So the break even point is where is your level of sales where gross margin is zero or where net income is zero if you have a good sense for your overhead expenses. So if this business generates $4 million of revenue instead of $5 million of revenue, net income goes to zero. It's completely worthless. That owner would be better off getting a job at a fast food restaurant part-time, would come away with more after-tax cash flow. And that is what I think is really important to highlight, because your business should be compared to what else you can do with your time. There are certainly some liberties that small business owners have, and if it's about flexibility, that may be part of your mission. Part of your mission may say, I really, in terms of not generating that much income, it's perfectly okay to say, I'm quasi-retired. I really am just trying to fill my time 20 hours a week. And if I can get to $40,000 by the end of the year, that's great. That's achieving my mission. For other businesses, their net income needs might be much higher. Certainly in the Bay Area, that would be the case. So some other things that stand out in this picture to me, and this is not that far off from what we actually see out in the wild. Excuse me, we see that this company is spending $150,000 in a year on travel expenses. And this is a construction contractor, so I don't really understand why. Now, there may be a reason. Maybe this contractor is trying to develop business in another state or somewhere where there's a lot of travel involved, but it would certainly be worth asking a question. Most contractors are local, so for a contractor to have really any significant amount of travel expense uh, is unusual, let alone in this case, we're talking about a dramatic portion of, I mean, this is taking up 15% of their gross margin just to travel. So I would be asking, what is going on? Even more surprising, perhaps, is that this business is spending $50,000 on meals. And yes, there's a reason I've come up with this hypothetical example of high travel and high meals, because some business owners, again, confused about what the goal is, attempt to put some expenses that are really personal or may to the business owner appear as partly personal, partly business, and they're adding it into their expenses. This is hurting their bottom line. It may be evading taxes. So those are questions that I would ask. And that the sum of that, if they didn't have travel expenses and they didn't have meals expense, net income would be twice as high. So, and that then net income would be 40% of gross margin, which is just what we had in the prior example. So in this case, they're hurting the whole picture, and it really doesn't seem consistent with what a typical construction contractor would be attempting to do. So we've got, as I mentioned before, we've got $200,000 of income, nothing to sneeze at there, but that income is only 4% of the total sales. So for all of their efforts to generate such great revenue and bringing in customers that are willing to pay that price, they're really not making very much money per dollar of income. So those are the comparisons that are helpful in terms of analytics that you may not realize. Your profit and loss statement is telling you a lot about what your mission is and how you're achieving that mission. So overall, in this case, we've got relatively low income as compared to sales. We've got some questionable meals and travel expenses, and we have a really high break-even point, which makes this a risky business because if this business has a bad year, things are going to go upside down very quickly, and they're going to be they're going to be losing money. So the third example we're going to look at is business mysterious magic. So this is a magician, and the what we see overall is that, or what we see right away is that we have a net loss at the bottom. So this business bringing in $80,000, not a tremendous dollar amount, but maybe this is something that the magician does after hours. The magician has a regular day job, and this is something that's just adding 80,000, no problem with that. But the fact that this business is losing money makes me wonder, is this a business or is something else going on? And they thought that being a business was the right formation, but it really shouldn't be for tax purposes. So we can see that this business lost money. So they violated the number one rule of making money. It is acceptable in some businesses, in some cases, to have years where there are losses, where other years have extraordinary gains. It is not okay to have repeated losses or really low income. I mean, trickling amounts in the single digits of thousands of dollars as your net income, because you're poking the bear in terms of the IRS standard for what is a business. And that's really the risk. It's perfectly fine to go out and be a magician on weekends and know that that's a hobby, not a business. It's something this person might do for their own enjoyment and should not be reported as a business on their tax return. Because some endeavors are knowingly going to cost more than there's going to be any benefit. I'm thinking recently of Burning Man, that big festival in the Black Rock Desert that just ended. That is a great example of a hobby where people spend tremendous amounts of money to create the art and the exhibits that are used there. That is not a business. They're just spending that money. They're after tax cash flow, and that's perfectly fine to do. It would not be okay to report that as a business because there's literally, it's impossible to generate revenue, which is one of the rules of Burning Man, that no money changes hands at the event. So it's okay to have a hobby. It's, in my view, not okay to have a hobby that you're reporting as a business. So some other things that stand out, same thing as Casey's Construction, where this business is spending $40,000 on travel. And I'm going to say if $80,000 is the revenue, I mean, I shouldn't be so skeptical. Perhaps this magician is traveling really all over the country, and the amount of revenue that the magician can generate is just not that high because the market doesn't hold that much for revenue. But in this case, if the business is really, if this endeavor is really not profitable, then it should just be viewed as a hobby. So also similar to the Casey's construction, the meals expense for a magician should be a pretty low number, if anything. And in this case, this business is spending this, and this magician is spending 830, just over $830 a month in meals. So something seems really fishy about that. And even the office expenses are not that high as a percentage of revenue. I mean, they're high, but that for other businesses, it would not be ridiculous to have, this is approaching, let's call it 20% of revenue spent on office expenses. That's high, but not ridiculous in relation to revenue. But it is high when you consider this is a magician. What possible office does this magician have that would cost that much? So even the supplies seem a little on the high side. So I've got a lot of questions about what these expenses are. Utilities, just everything stands out here. So our overall is that there's no income. So that's super wrong. There are questionable expenses in other categories. So we really want to ask this magician whether this is really a hobby, not a business. Difficult maybe for some to think about what they're doing as a hobby when business has a lot of excitement and buzz to it. But business needs to focus on generating income, which is really what this is to emphasize. Start with income. And I say passion is optional. I only say that because there's a lot of buzz now about finding someone's passion and really wanting to serve customers. All of those are great altruistic desires, but when it comes to business, the income has to be the number one rule. And this is just to get clarity on what is a hobby versus what is a business. So generate income over the long term so that you understand what success is and you have options for whether you contribute to your retirement or just have confidence about being a legitimate self-employed individual. It's a wonderful thing. So also, just to reiterate, income tax and self-employment tax, which is how self-employed people pay Social Security and Medicare tax, is perfectly normal. It's necessary. It's part of how business operates. No matter what business you are, the more successful you are, you're going to pay the appropriate amount of tax for that level of income. If you're not paying tax or if you're paying very little tax, that really puts the question out there about, are you a business? It doesn't make you savvy in business or clever around taxes. Just earn income, pay the tax, enjoy the end result of your business. There's really no reason to try to scheme when it comes to taxes as related to business earnings. So some final tips would be in your mission, especially as a small business owner. I think it's really important to put in the financial elements of your business in your mission. And again, hearkening back to what we see with Starbucks being really, I'll just say fluffy about their mission. I think the smaller the business, the more important it is to call out what your revenue target is, what your expenses are expected to be, and what you're trying to generate as net income. So this example is an interior design firm specifying that their customer is going to be in and around San Francisco. They have specified an average price per engagement, and they're trying to generate total revenue of $250,000 and get net income of $125,000. So that's a great mission because it says who the customer is, and then you'd probably have more aspects of where you're trying to find your customer and what you're trying to sell to them in terms of labor versus components. But more or less, the critical thing is to specify what your revenue target is and what your net income target is. And I want to say finally that in your business, I think it's so important to be upfront and confident about your pricing and about the money that's going to change hands between your customer and you as a business. Again, there's some hesitance, I think. I don't know why this has developed as part of how people look at small businesses in the United States, but I think there's kind of what am I trying to think of, like a mechanism out there that is telling small business owners to hide pricing and to be a little more mysterious about the money part of it. And I think it's important to start with so be really clear about money. For example, in my tax preparation business, one of the most common questions I get from prospects is how much is it going to cost for you to prepare my tax return? So I decided to just come up with flat prices and to put those prices on my website. So there's no mystery about the money part of it. So with that, I see there was one question that came up. Of course, we want to emphasize to use the resources of the SBDC that you have. Of course, I'm partial to the North Central Texas SBDC, but wherever you are, as you have those resources available to you. So, do we have questions?
Yeah, it looks like we have one in the chat,
Okay.
Bryce. Let's see. If your business suffers a substantial loss in a year, what documentation should you have to support that loss on a P&L statement?
Yeah, the most important thing is to be able to. So, in terms of documentation for the P&L, for any P&L, in terms of what the IRS is going to be looking for, they have to prove income, you have to prove expenses. So you need two things to support expenses. You need the evidence of how the money left your account. So that's the credit card charge statement or the bank statement that shows the debit. Or if you pay via credit card, then ultimately the bank payment to pay off the credit card. And the second thing is the original receipt that shows what was actually purchased, the description of the item that's purchased. And sometimes business owners think that all they need is the bank statement, and you actually need the original receipt or the source documentation. When it comes to a loss, that can happen, in certain industries, they're going to be hit in a given year. I think pandemic's a good example where a lot of businesses went upside down in that period, and that's perfectly normal. What you want to be able to do when you have a loss, if the IRS is asking, you obviously want to have support for those expenses, documentation, just support, receipts kind of stuff. And then what you would also want to have is just a narrative explanation where you can say to the IRS, here you can see for the last 3 years or 5 years or 10 years, I was generating the income. And then this event happened. And, maybe it's something local that happened in your community where it just rocked your sales, and all of a sudden you were only able to sell half that year. So you're saying, you can see my sales went down, all the other expenses stayed the same. Or on the flip side, maybe you generated the same amount of revenue, but you had a dramatically higher expense, maybe a legal settlement. So just having an explanation of why did my income picture change from from one year to the next. Other than that, you should see relatively consistent numbers from year to year. And that's another thing that you can look at in your profit and loss statement to compare it over a 5-year period. And you should be able to basically know what the nature of the changes were.
Yeah, yeah. We have another couple of questions here. If you list your prices on the website, do you expose them to your competitors? How do you overcome this, when you have it?
Yeah, I think that any business should be confident enough in their value proposition to their customer, and that's not every customer, just that business's customer, that they should be willing to show their prices. And I worked with a client who was in that exact scenario where the last thing they wanted to do is publish their prices on their website. And it was precisely so that their competitors couldn't see um, and 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 change their pricing based on what they would say. This is a leading business selling molding, like base molding, crown molding, and they're the leaders. So other businesses can copycat off of their pricing. So I acknowledge that your competitors are going to be able to do that, but they're going to be able to do that anyway. If your competitor is really intent on knowing your prices, then they can be a customer or have someone as a shill to be a customer and find out your pricing. So, so I think if your value proposition is clear enough to your target customer, you shouldn't have to worry about publishing prices. I mean, very large businesses, Home Depot, Starbucks, their prices are very well known. And I think it creates more, because the flip side of not being clear on pricing and publishing that to your target customer is that then your prospect is unclear about what they're going to pay. They have to inquire. There's more barriers to doing business with you. Whereas if you're saying, here's what we can do for you and here's how much it's going to cost you to work with us, then the customer's clear on that.
Yeah. I just have a couple of comments and a question. The comments are kind of related right to what the crust of your presentation is. But here at the SBDC, we see a lot of clients coming through, and some of those clients we observe, right, might be spending too much time on the prep of their business and not focusing on the revenue, right? The prep is important, but revenue is what makes a business. And so just kind of talking on that subject, um, you know, and and that and that energy that they spend saying, well, I want to write this off. I want to write this off. I want to be able to write this off. The energy that they spend sometimes just in those conversations, boy, if they spent that kind of energy on revenue generation, it would be, a completely different story. And when it comes to, that bottom line of making money, we've also seen the businesses come in where there's been something that changed, where, hey, there's an opportunity for me to grow in this area and I need to get a loan for it. Well, because you've been trying to minimize your taxes, now we can't qualify for this loan that, is this great opportunity over here. And so I think that
Really
this
great
plays
point.
along the lines of what you're in. But my question is, I've often heard when the businesses are quote unquote losing money on the bottom line and reporting that to the IRS. that there is a certain trigger point that happens inside the IRS when they've done that for so many years. And I've sometimes heard 3 years, I've sometimes heard 4 years, but when you've consistently reported a negative, you get elevated up to that audit level much higher.
Right. And it can be the amount of income too, even if it's not over a long period of time. So the 3-year baseline is about right. And I will admit, unfortunately, the IRS they're not as meticulous as I'd like them to be. So there can be a business that is losing $1,000 a year for 10 years, and they may not get questioned because their overall income picture might be very high. They're still paying in a lot of tax. But to give another example of an actual client I represented, I didn't prepare the returns, but I represented the client before the IRS. He made about $250,000 in wages. This is individual in San Clemente, which is where President Richard Nixon lived. And he had it wasn't really a business, but he had an endeavor where he reported $50,000 of loss in a given year. And that's where you can see that gets the IRS's attention very quickly, because 20% of what this person would have paid in income tax was being offset by this business loss. And as should be no surprise, it didn't play out well for that individual. So
yeah. Cool. Do we have any other questions from anybody? All right. Well, I'd like to thank everybody for joining us today. Just as a reminder, we're going to be sending out a survey, so you can comment on today's webinar. And then I'm going to go ahead, Bryce, if you'd unshare, I'm going to share mine. I believe.
That's the hardest part, always.
All right, there we go. Okay. Can everybody see that? Yes, okay.
Yep.
All right, so this is just kind of a prelude to some upcoming webinars that we have. You can see that we have some more QBO coming on the 17th of September with Stacy. That's going to be a great seminar there. We also have some HR endeavors coming up as well, and some more coming up in October too. So please check those out. At the bottom of this slide, you'll see that you can visit our website, right? And that's at sbdc.nctc.edu. You can register there for these webinars. You can also get more contact information. You can schedule appointments with us, the advisors here at the center, and a lot of other resources that are available there as well. We're also grant funded, as I mentioned in the beginning, so I'd like to kind of thank some of our sponsors, which is the Small Business Administration, the state of Texas, the North Texas SBDC Regional Office, and the North Central Texas College. So thank you everyone for joining us today, and we look forward to seeing you on the next one. Thanks again, Bryce.
Hey, thank you.